This video will walk you through the solution to exercise 1312, which focuses on accounting for convertible bonds and includes issue and conversion under both IFRS and ASPE. Here's the data for our problem. On January 1st, 2025, Deliverance Corp offers 5-year, 9% convertible bonds with a par value of $1,000. Interest is calculated every January 1st. Each $1,000 bond may be converted into 500 common shares, which are currently trading at $3.50 per share. The effective interest rate on bonds is 10%. Deliverance issues 1,500 bonds at par and allocates the proceeds under the residual method using debt first, with the remainder of the proceeds allocated to the option. On January 1st, 2027, right after the interest payment, Deliverance offers an additional cash premium of $10,000 to the bondholders to convert. The bond's fair value at the time of conversion is $1,470,000 without the conversion feature. The company follows IFRS. There are 3 requirements for this problem, so let's begin with requirement A, which asks us to record the journal entry or entries for the bond issuance. Again, this is under IFRS and the residual method. Let's start with the easy item. On January 1st, when the company issues the bonds, it will receive cash. The company delivers 1,500 bonds, multiplied by a $1,000 par value. That's $1,500,000, and that will be the debit to cash. Next, under the residual method, we want to determine first how much of the cash proceeds will be allocated to the debt component or the bond payable. Using our calculator, we will enter 5N because this is a 5-year bond. We'll enter 10 IY because the effective interest rate is 10%. The payment is going to be 9% of $1,500,000 or $135,000, and we'll enter $1,500,000 FV. Press the compute button and then PV will end up with $1,443,138. That's the amount that will be credited to bonds payable. The remaining amount then is the residual, which is $58,862, and that will be allocated to the equity component of the instrument, so we will credit an account called contributed surplus conversion rights for that amount. On to requirement B, which now asks us to record the entry or entries for the bond conversion. At the time of conversion in 2027, 2 years have passed. So what we want to do is determine what the balance of the bond payable is with 3 years remaining, 5 minus 2 years. So let's recalculate the present value of the bond using 3N instead of 5N. Now, if you haven't overridden any of the time value variables in your calculator, all you need to do is overwrite N. So press 3, then N, and now recompute the PV, and we should end up with $1,462,697. That's how much we will debit to the bond payable account to remove the bonds because they're all converted. We're going to remove the contributed surplus balance that we set up when the bonds were issued. So we'll debit contributed surplus conversion rights for $56,862. This now eliminates the balance in that account altogether. Next, we can record the cash component. The company is paying a $10,000 cash premium, which is also known as a sweetener. So we're going to credit cash for $10,000, and at the same time, we'll debit a loss or redemption of bonds for $10,000. The sweetener is in essence an additional cost the company bears to promote the redemption of the bonds. The final amount to make the journal entry debits and credits balance is a credit to common shares for $1,519,559. And that's the sum of the bond carrying value plus the contributed surplus balance plus the sweetener. And finally, for requirement C, we're to assume now that the company follows ASPE and to record the entry for the conversion under this method. So under ASPE, when the bonds are converted, the first 2 journal entry items are the same. The company is going to debit the bond payable for the balance of the bond at that date, in this case for $1,462,697, and also debit the contributed surplus for conversion rights for the amount that was set up initially, of $56,862. This is the same as IFRS. Next, under ASPE, we have to determine if there is a loss and redemption of the bonds. So in this case, at the conversion date, the fair value of the bonds is $1,470,000. And if the carrying value is $1,462,697, that means that there is a $7,303 loss on redemption. So we're going to debit a loss on redemption of bonds account for $7,303. Now we can deal with the cash sweetener. So we'll credit cash of $10,000. And the difference between the cash amount and the loss on redemption we just calculated is a difference of $2,697, which goes directly to retained earnings. So we're going to debit retained earnings for $2,697. It's important to note that any loss and redemption of bonds plus retained earnings adjustment must equal the total cash paid to promote the early conversion of the bonds. Or essentially, when you take the cash minus the loss, you end up with the amount of retained earnings. And then finally, to make the debits and credits balance, we're going to credit common shares for $1,519,559, which is the same under IFRS. However, in this case, instead of the entire amount of the cash sweetener allocated solely to the loss on redemption, we only recognize the loss on the difference between the fair value of the bonds and the carrying value of the bonds, with the remainder to retained earnings. And that's it. We're finished with this problem.